Hello, everyone. Bailey Peachy here again, and welcome back to part 5 of our Trade Business Accountants Cash Flow Masterclass. We're an accounting firm that works exclusively with Australian trade and construction businesses, turning anywhere between $1 and $10 million a year to help them build greater security by dramatically increasing their profits in cash. And the reason for this training is that for everyone less than $1 million a year, we want to help you get there so that, hey, maybe someday we can work together. And at the very least, we just want to provide you value. And for everyone above the $1 million threshold, we want to help you simply do better. At the very least, we can showcase what we know, and maybe someday down the line, you'll consider hiring our accounting services to help you do all of this. So let's dive back in, continuing on with the strategies to improve the 7 key levers within your trade business. Next, we want to talk about decreasing cost of goods sold. So commonly referred to as COGS. COGS are your job-specific costs. So your labor, materials, subcontractors, equipment hire, pretty much all the costs directly related to actually delivering the work that you do. As you would have seen in our client examples that we've gone through, reducing your COGS by even just 1% can have a massive, massive impact on your cash flow, sometimes even more than increasing prices. So this is a really important lever to look at. And some strategies that you can use to reduce cost of goods sold might be reducing any material wastage on site, right? Could be leveraging overtime and better planning to maximize labor productivity. Could be keeping your field workers as billable as possible throughout the day. You could renegotiate wages or better structure salary packages with your team. You could negotiate with suppliers to get better rates or change suppliers altogether. You know, we've had clients save upward of $80,000 on jobs simply by changing suppliers. So don't feel like you necessarily have to be loyal to people, because if you're a nice guy, people might take advantage of that. You can also look to better manage your material supply invoices and make sure that you aren't being overcharged. You can better schedule and plan jobs to reduce any on-site efficiencies. You can limit any callbacks and rework. You can streamline and systemize job processes with software. So there are plenty of really great job management software and other tools out there that you can use to better the efficiencies within your business. And you can better lead and manage your crews. So 1% improvements across all these areas, for example, could have a huge impact on your cash flow. You know, the better that you or your management team lead and drive efficiency, particularly on the ground in delivery, backed up by effective planning and preparation, the lower your cost of goods sold will become. Next, let's talk about decreasing overhead. So spending money obviously has to happen in any business, but if you're not careful, overhead costs can quickly stack up and cause 3 things to occur. First, it's going to destroy your profitability, because when costs go up, profit margins typically go down. Secondly, it's going to destroy your cash flow, because you're most likely going to be spending money a lot faster than you can actually collect it. And thirdly, it's going to put a lot of pressure on you to continue locking in more cash to keep the juggernaut going, right? And this is where I see emotions begin to take over, where people start to price work just to win it rather than make a profit, purely out of desperation to keep the team busy, right? But busy does not mean healthy cash flow. So overextended overheads are bad for you, and they're bad for your business. Now, it's very easy to get caught up in the day-to-day and lose track of where your money is going, or even just to spend small amounts of money consistently and not know the total impact of those decisions over time. So we need to be smart with how we're spending our money through the business, which might sound really obvious, but this is a really common problem. I once worked with a small painting business, and I'll use this example to paint the picture of how bad things could be as you grow and expand your team. Pardon the pun there. But at the time, this client was reckless with spending, absolutely reckless, which ironically left him wondering things like, hey, where is all my money going? I should have more money by now. Why is more work not solving the problem? And he was getting really frustrated at how little cash he had left over in his business for all the work that he was putting in. He was turning around 60K a month. So again, on the smaller end here, he was really, really efficient in delivery, and his gross profit margin was really strong. It was actually around that 50 to 60% mark. He could sell really well, and clients loved him. You know, everything was extremely solid except for his overheads. His overheads were sitting at around 55% of his entire business, right? And on top of that, money was also being spent left, right, and center. And because of this, he was only making around $17,000 net profit per year on top of his salary on paper, with no cash left over in his bank account. So when he started working with us, we immediately removed all of the wastage and cut down his overheads, which skyrocketed the cash that he made on top of his salary to $94,000, which is a 452% increase. Now, this is a very extreme example, and I wanted to use this example because it's a small business and it is an extreme example. Because imagine what could be happening in your business if you're turning 1 million, 3 million, 5 million, or even $10 million a year, and you aren't across exactly where your money is going, right? How much wastage could there be in your company if you are not on top of your spending? You need to be running as lean as possible without hindering growth, profits, and productivity, only investing in overheads that are actually needed, right? Because you can live without more things than you think. You can operate with less than you think, and your business will thrive with less than you think. So what you need to do is review your overheads. Most people have at least 3 to 5% of their overhead expenses being spent on stuff that they don't use or they don't actually need, which really is cash that shouldn't be funding wastage. So to review your overheads, what we do is we look at your overhead percentage, your profit and loss line items, and then your transactions. Starting with the profit and loss. So first, take a look at your profit and loss statement for the past 12 months. What I want you to do is then divide your total overheads by your total sales and then multiply that number by 100. So for example, let's say that you have $339,000 in overheads. You divide that by $1.3 million worth of sales, and then you multiply it by 100. That's then going to give you 26%. And what that means is that for every single dollar that you sell, 26 cents worth of that dollar is used to cover your overheads. Now, a healthy trade business, in my opinion, should really be aiming for that 18 to 25% overhead percentage, right? And again, this of course can vary depending on your business and what you're trying to achieve. But as a general rule, if you're sitting within this range, you're likely doing well. Now that you have a percentage, look through your profit and loss to review them. Does anything that you're looking at stand out? Are you spending too much money in any certain areas? Do you need to remove anything, right? Again, if you're not at that 18 to 25% mark, then you may need to either increase sales or increase your gross profit, or you're going to have to lighten your pack. It's your call. Once you've done that, I want you to next go through your transactions because the devil is always in the detail. Dump your last 12 months worth of transactions into a spreadsheet and go through them line by line. Now, if you have a bookkeeper or a proactive accountant, get them to do this for you. In my small painters example, I found 6 insurance companies with $3,500 worth of costs that weren't necessary. He was spending $12,000 a year on social media management that was doing a really poor job that he shouldn't have been paying for. There was a networking group that he'd never used before that was costing $18,000 a year, right? Which is just ridiculous. And then on top of that, there was almost $3,000 worth of ATM cash withdrawals, which is a big no-no. There was just over 14 grand spent on fast food and fancy dinners. There was $3,000 at Pet Circle. There was over $6,000 spent on 2 phones when he only needed 1. There was $3,000 sent to a charity, which is great, but not when you have no money to run the company. There was a storage unit that was costing almost $5,000 a year that wasn't even being used, and he'd actually forgotten that he was paying for it. On top of that, countless unused subscriptions, just to rattle off a few things. But everything that we found added up to around $77,000 worth of wastage that should have been cash in the business. And that is why it's important to review spending and your overheads. Because again, that's just a very small example. You're likely running a larger business. So what could be going on if you aren't on top of this stuff? Other examples might be reducing the days that your cleaner comes to the office, or selling off any underutilized assets like machines, or negotiating better deals with your suppliers, or insurance, or adjusting phone plans, or just even making sure that your team aren't wasting money. And for some of you listening right now, this might mean sacrificing certain luxuries until you can actually afford to have them. And I say that because once a business starts making profit, it can be really easy for the owner to start taking their foot off the gas, right? And make poor financial decisions. Or a really common issue that I see is that contractors are growing rapidly, right? They got so much going on. And they're being so consumed by all the busyness and the growth that they can overlook certain things, or they let certain things slip away from them because they just haven't had time to sit down and actually track this stuff. And they might not be getting the help that they need to make this happen. So just remember, every little expense adds up, no matter how big or small it is. You have to have a tight grip over your spending. And as I've tried to make very clear throughout this training, if you do not understand the numbers and the math behind your business and where your money is going, being busy, working hard, and taking on more work will often not lead to a better result. You need to know where you stand with this stuff. Next is decreasing your receivable days. So one of the biggest areas that trade business owners fall down is in collecting money from their customers. And here's the thing, on average, 5 to 15% of revenue goes uncollected every single year, which is a lot of work being delivered for free. And let's say that you're doing $1 million in sales and just 5% of that goes uncollected. So on the lower end here, 5% of $1 million is $50,000. Now, you might be thinking, well, 50 grand compared to $1 million, it doesn't seem like a whole lot of money. I could probably live with that. But you have to understand how this impacts the bottom line. So let's break it down. Let's say that you have a profit margin of 10%. This means that $100,000 of that $1 million should be profit. But because of the lost $50,000 worth of sales, your profit is actually only $50,000. So suddenly that uncollected 50 grand seems like a lot of money, especially considering this 5% of uncollected sales is the equivalent to 50% of your profit. And to make up for that lost $50,000 worth of profit, you're going to need an additional $1 million worth of sales just to get your profit back to where it should be if you actually collected all of the money owed to you, which is just insane. You'd have to literally double your sales. You'd have to do $2 million in sales to get the profit that you should have collected, as opposed to $1 million, which is a lot of work and a lot of effort to get the results that you should have gotten in the first place. So you need to be collecting money much, much faster in your business, because the sale only ends once money exchanges hands. I know an electrical contractor that at the time was growing rapidly, but he wasn't tracking his receivable days. And it turns out that he was so busy winning work and delivering projects and keeping his clients happy that he had over $700,000 that he had not collected over the past 2 years that he had completely forgotten about. Like, he didn't even know it existed. So if you want more cash, reduce your receivable days and collect the money that is owed to you. And again, it sounds obvious, and it's not as if you don't know that you need to collect money from your customers, but oftentimes in life and in business, we need to be reminded more than we need to be taught. It's like reducing your overheads and staying on top of your spending. In the busyness of business and with everything you've got going on any given day, it isn't always easy to be across this stuff. So just see this as your reminder to reduce the amount of time that it takes to collect the money owed to you, to increase the chances of that collection actually happening. Some ways to do this are use your accounting software, right? Generate a report of what money you have outstanding and who owes it, and then go through that list in order of most overdue and start the follow-up process. Call an email, call an email, call an email, right? Communicate price and payment terms upfront. Hourly rate, quoted, inclusions, exclusions, whatever it is, this is all about educating our customers on how we do business and what we expect from them. Also get approval and a written signature before starting any works, which goes for variations too. And on a side note, make sure you're actually charging for variations. I see so many trade business owners get stung by this one. If there is no signature, you do not proceed. Get a deposit wherever you can. So this isn't always possible depending on what you do, but the aim here is really just to reduce what you need to collect from a customer once you finish your work. In alignment with that as well, take payment on completion. If that's not possible, shorten your payment terms to get them to a 7-day account. Now, if all your work is with builders and the like, and you're on 60 to 90-day payment terms, hey, consider other customer groups. And also in that instance, build a great relationship with the builder and with the accounts person. You also need to invoice your customers as soon as possible. I cannot stress that enough. Too many contractors are just not invoicing quick enough. The average time between invoicing a client and receiving payment, in Australia at least, is 44 days. So that's 44 days without cash that's owed to you. So the faster that you invoice, the faster that you get paid. That's the general rule here. Also follow up relentlessly. Right? You need to have a system in place to follow up and chase your money. You've already done the work, so you deserve to be paid for it. Don't just assume that because you've sent an invoice that everyone will automatically follow your payment terms. It's not how it works, right? And on that same note, collect debt weekly. I get that it can be uncomfortable chasing payments from people, but you have to collect outstanding debt every single week, because it does not matter how much profit you have on paper. It is cash that pays the bills. Next is decreasing your works in progress or your stock days. This is all about reducing the time it takes for you to invoice works in progress and reducing the number of days that you hold any inventory or stock. Again, we want to get cash in the door as fast as possible. The longer that both stock and WIP are held by you on your balance sheet, the greater your working capital will be. So you need to do everything that you can to limit your WIP and your stock. And you can do this by limiting the variation in material, brand, and product types so you're more frequently using your stock rather than having stock that rarely gets used collecting dust on the shelves. Right? You can have more accurate order sizes to limit your outgoings. You can renegotiate supply lead times to also limit the time that it takes for you to turn supply purchases into cash on a job. You can use a job management system to better manage your stock and inventory so you know what you hold rather than just forgetting what you've purchased and then never using it. And you can invoice WIP earlier and more frequently, kind of tying into what we just spoke about, so that you're getting cash in the door a lot faster and a lot more regularly. So this is all about your payment terms. Again, it doesn't matter how much profit you have on paper. It is all about cash, because that is what's going to fund the business, pay all your bills, right? And then lastly, decreasing your accounts payable days. So this is all about holding onto your cash for as long as you possibly can to make sure that you are never finding yourself strapped of money to run and fund your business. There isn't a whole lot for me to say about this one with the time I have left, but really just make sure that you are maximizing your payment terms with your suppliers. So don't front your cash to fund projects. Purchase materials where you can on credit terms. And then make sure that you are building a strong relationship with your suppliers where you earn their trust and can negotiate more favorable terms to better protect your cash, because it's a timing game, right? Increasing the cash coming in and then decreasing and slowing down the cash that is going out. So if a payment is due on the 30th, pay it on the 30th, not prior. Don't pay anything until you have to. That is my recommendation. And this is how, you can begin to make these 1% improvements across the 7 levers in your trade business. And as another visual here as well, this is what the relationship between accounts receivables, WIP or stock, and accounts payables looks like. So this is the comparison between ABC Plumbing's working capital timeline between 2020 and 2021, when they grew from 2.9 million to 3.4 million. And you can see here that their working capital days increased by a total of over 21 days, which had a negative $153,000 impact on their cash. In this particular case, that improved their payable days by 10 days. So they paid suppliers 10 days slower, which was great, but they held stock and increased their WIP by 16 days, right? And their receivable days increased by 5 days, meaning that they were getting paid 5 days slower on average. So all up, this added the extra 21 days to their working capital timeline in 2021, and it cost them $153,000 in cash. So again, this right here is why you need to focus on reducing your working capital timeline by getting cash in the door faster and slowing down any cash going out the door. Now, up until this point in our training, you might be feeling like you've just tried to put your mouth over a fire hydrant, and you might be feeling a little bit overwhelmed with the amount of information that we've just blasted through here. But this is why we've built this training and we've released it for free, so that you have access to this for life. Right? You can go back through things at your own pace. And then also in our portal, you'll be able to access free downloadable bonuses, including a worksheet with all the key takeaways to help cement the lessons here. Again, so if you're in the portal right now, that downloadable worksheet is literally directly below the video. But if you're watching this on YouTube, just click the link in the video description below to see what I'm talking about. Again, it is all free. So please, I encourage you to go use those tools that we put together. But to conclude this masterclass, if there was only one thing that I would want you to remember, it really would be this. There are only 7 levers that you need to focus on to start flooding your business with more cash: price, volume, cost of goods sold, overheads, accounts receivables, WIP or stock, and accounts payables. These 7 levers must be your focus leaving this training, because you now know that these levers can make you significantly more money, right? And if you were to even make an extra $100,000 worth of cash, wouldn't that have a huge impact on your life? So instead of only making what you're making now, I hope you're going to actually commit to me, yourself, and the whole world to use these 7 levers in your own business, because I promise you it will change everything. Using these 7 levers will allow you to flood your business with more cash and dramatically increase your income.